What's new in tax 2025? So every year there are tax rule changes here in Canada. So let's talk about the six main tax changes for 2025. So today what we're going to learn is what are the two big uncertainties that are gone now? What are the six main tax changes for 2025? And what's the new picture for saving for your first home? So, all right. So the most important changes this year is actually the two big uncertainties are both gone. These are both things that worried us a lot. So the first one is the new reporting requirements on trust. It's trust. So it's still gone, but part of the requirement was to require them on what's called bare trusts, which applied to a lot of people. So, and the requirement was to file a T3 tax return, and there's a new Schedule 15. So it's a pretty onerous thing to file. So last year, this was announced, and these had to be filled out by everybody that had a trust or a bare trust. And then on the last possible day, it was canceled. It was deferred until this year. By then, lots of people had already spent $500 or $1,000 with their accountant or taxpayer to file these things, only to find out they weren't necessary. And so we were kind of worried that this was going to happen again this year. But they have actually now canceled it completely for the bare trusts. Okay, now bare trusts apply to a bunch of things, but there's a few specific areas where it would affect a lot of people. So the first one is for what's called in trust for accounts, ITFs. So these are informal trusts, and a lot of people use these to save for their kids, either their homes or their education. In addition to the RESP, they can do it for their home down payment, for a wedding, car, or for any other reason. So RESPs are good for saving for education, but the in-trust for accounts is how parents save for kids for anything else. They're also used for saving for other family members, so our nephews and nieces and stuff. So now a reasonable number of these would be over 50,000, and so then it would apply. So what we had actually been doing for a fair number of our clients is we've been splitting these into separate ITFs, which the rules weren't clear, but we were kind of told we believed it would have been fine. So one separate one for each parent, in trust for each child. Therefore, there's two parents, two children, you can get up to 200,000 without running into a problem. So that was the whole issue there with those. The other one is with either bank accounts, mortgages, or homes where they're joint between family members, usually parents and children. So where this would typically happen is a fair number of parents are helping their children buy homes now because they're so expensive. And what they're doing is they often go on the title or on the mortgage, the parents do, until the kids pay their part off. Okay, so and the problem with that is considered to be a bare trust, so they would have to file these forms. And most of those people didn't even realize it was one. The other one is for people that have aged parents that are they're worried about dementia or whatever, and also they're thinking ahead to the estate. So this is often parents that are over 80, and a lot of people are going on jointly with their parents. Their aged parents, so on their homes or their bank accounts or their investments. And this could simplify the estate if it all switches over to them. It could also help them avoid probate fees. So this is something that was done quite a bit. Bank accounts were often done just to help them pay bills and keep the financing and all that. So these things are actually problems when people put them in. So you have to think them through carefully, because we've seen lots of people do crazy things to try to save a probate fee. Probate fees are like 1.5%, depending on your province. It's not 54% like income tax. So you don't want to do all kinds of major things. And actually, when you do this, if you don't think it through, if the will says something different than these joint amounts, or you haven't thought through the tax consequences, they can be a problem. Okay, but anyway, so now these are allowed, but we're just urging people to still be careful how you use them. But now we don't have to worry about filing these T3 tax returns for those either. So for the jointly owned ones, or for the in trust for accounts. So we think that CRA kind of realized that they're trying to go after a small number of people that are using different kinds of trusts for hiding money, but they end up creating a very onerous tax filing obligation for and probably 1 million clients or Canadians or more. And there was a very hefty penalty, $2,500 for just for not filing it. So that was quite a big problem. The other big uncertainty that's gone is the capital gains inclusion rate. Now, it's been deferred to January 2026 instead of mid-June 2025, mid-year. to the next year. So, and we think this probably means it's going to be gone completely. So this was an increase from 50% of a capital gain being taxable to 67%. So it's actually a 34% tax increase, which is a lot. And it would apply to individuals with capital gains over 250,000 or corporations with any capital gain. Now, CRA was, the weird thing about this was CRA was going to enforce it even though the motion was never passed. So it was stuck in, the Parliament was frozen since September, it was stuck in there, and then when Parliament was prorogued, that actually canceled it. So that means it would have to be reintroduced from scratch. So we think that the next government likely is not going to do this. So we think it's probably gone. This probably would have affected for individuals, mostly people with rental properties or cottages, because real estate, you only sell them in one shot. So you bought a cottage or rental property, 20 or 30 or 40 years ago, you sell it to you this big capital gain. So 250,000 isn't that big of a gain if you've held a property for a long time. And so a lot of those people would have been nailed by this. Stock market portfolios, if they plan it right, it wouldn't have affected that many people. Like even, people with a $5 million non-registered account can very often plan to not trigger more than 250,000 in a year. So it wouldn't have affected that many individuals for stock market portfolios, but would for real estate. So now the big place where it would affect a lot of people, though, it would affect anybody that had a small or a large business, also self-employed people that have corporations. So there's lots of them. So, and this is actually a routine tax planning things. Like we've advised many clients to create a corporation and then use it as part of a tax deferral by investing inside their corporation. It's a version, it's a tax deferral different than RSP, but a bit like it. And by leaving money in the corporation and not paying it themselves, they get a deferral. So it's a very common thing to save for self-employed people, to save for their retirement inside their corporation instead of in an RSP, done by a lot of doctors too, which is concerning. So now we've been concerned that this would make Canada's tax on capital gains, quite a bit higher than other countries, so we wouldn't be that competitive. It's like especially the U.S. So it could drive out some investment from Canada and some doctors. So and we have actually quite a few self-employed clients with corporations that would have been affected by this, but we think it's probably gone. So those two big uncertainties are gone. And the odd thing with both of them, in both cases, we weren't sure how we were actually going to file the tax returns. Even when it's coming up to the deadline, you're still not completely clear. And but anyway, they're gone now. So now let's talk about the other changes. Now there's actually fewer tax changes this year than most years, and part of that, I think the main reason is Parliament was actually been shut down since September, since shortly after the summer break. So not that many things actually got passed. So one of them is actually the charitable donations deadline was changed to February 28th instead of December 31st. So any charitable donations you did in January or February this year, you can actually claim them for last year. And this was just because of the Canada Post strike in December. So it was kind of to make up for that. So now the more significant one here is the Homebuyers plan withdrawal limit has been increased. So it's now 60,000 up from 35,000 for individuals effective April 16th of 2024. So, and the repayment is also deferred to start after 5 years instead of after 3 years. So that's all kind of a plus. Now, for first-time home buyers, by combining this with the First Home Savings Account, the FHSA, and the Homebuyers plan, the Homebuyers HBP, combined with the Homebuyers plan, which is part of the RSP, they can contribute $100,000 and get a tax deduction for it, and they would then pay no tax to withdraw it to buy their home. Now, the Homebuyers plan has to be repaid. FHSA doesn't, but it's, you can save up money, get a big tax refund on it, and so it can make it easier, quite a bit easier to buy a home. And it is generally smart when you're buying your home to try to put the 20% down. So that can be, when you're young, starting to save up on down payment, that can be quite a challenge to do. So this will be helpful. So now this is $100,000 per person. It's $200,000 for a couple that they can save, as part of their home down payment. So now, if you might want to buy a home anytime in the next 15 years, contributing to your FHSA first is usually the best idea, like before RSP and TFSA. even if you might do it. So, and also, but for the home buyers plan, general advice is it's generally best not to use it if you don't have to, because you don't charge interest on it, but you lose the growth that you would have got on that investment in your RSP, which could be 10% a year or something. So it's generally best not to use it if you don't have to, but it is a lot of people, especially in expensive cities, have to do it. So that's the new picture for first-time home buyers. The next change is the short-term rental expenses limitation. Now, I've never seen this kind of a limit before. So if you rent a residential property for short periods of time, so less than 90 days, 90 consecutive days, then you must comply with provincial or municipal regulations and licensing, or else CRA will deny the expense deduction. So a lot of people were using Airbnb on many properties, and it's now being, it's quite a few of the major cities, it's been banned. And so what happens now is if you actually have it in one of those areas and you're still doing it on the sly, like still doing it even though it's not allowed in the city, what happens is you're required to claim the gross rent, but you can't deduct any of the expenses. So the tax on it would end up being pretty bad. So now there's transitional relief in the place for the 2024 tax year. So if you became compliant before the end of December of 2024, then you wouldn't have to worry about 2024 at all. But going forward, you will have to worry about it if it's at all happened. So I've never actually seen a case like that before, where you're required to claim income but can't claim deductions. So that is the one that's out now. So the last change that, more significant change is it's actually become much easier to sign up for the CRA My Account. Now, My Account is a good thing to have generally, because it's a good way to look up your RSP's rooms and your TFSA rooms, and also to get updates like when you get statements or you can see all of your accounts, all of your tax situation, and CRA often communicates that way. Also, there's been CRA scams out, and if you get a scam call saying, CRA wants you for something, first thing, go on into My Account and see, is it actually real? So now the document required, what's happened is it's just a lot easier to apply for it. So the documentation required, it used to require that you apply, and then to verify your identity, they would mail you something, which would take like 10 days to get to this code, and you have to go back into it. So it's kind of a real pain to do it. And now verification is much more simple. So you can kind of do this all in a few minutes and get your My Account set up and be able to see your CRA accounts. So those are the big changes, the biggest change actually for this, for 2025. Okay, so that's my talk for this week. My name is Ed Rempel. My blog is Unconventional Wisdom. It's the #1 blog in Canada for a financial planner. It's just my name, edrempel.com, or it's also unconventionalwisdom.ca. Remember, it's .ca only, not the .com, because we're in Canada. If you're potentially interested in talking to us about potentially working together, we offer a free 30-minute consultation. It's just edrempel.com/talk. Also, please subscribe to my blog, podcast, or YouTube. If you do, all that means is you get one weekly email with whatever my new post is. Also, I have a podcast, which is edrempel.com/listen, and YouTube is edrempel.com/watch. Thanks for listening, and we'll talk to you next week.